Welcome back to Rand on Real Estate. My name is Greg Rand. I'm your host on 77 WABC and WABCRadio.com. We're here talking about building wealth in real estate, and we have a call from James in New Jersey who's interested in Hawaii. How you doing, James?
Hey, great. How are you?
I'm great. Thanks for calling, and thanks for picking a market so far away, because that's part of the fun here is to kind of zigzag across the globe. Now, tell me about Hawaii. You have interest in there in general? Have you been there?
Yes, sir, I have.
And what are you thinking about?
I've been to the Big Island, and I had just bought a house a week before I had went, not realizing how affordable real estate was on the Big Island. And I was just wondering what your opinion would be over the next 2 years, whether it be vacant land or real estate with a house on it. What that would look like within the next couple of years, if it was worth doing. I guess specific information that you would need for that is my credit's not great, but I have a private mortgage with my family. So my money is not as strictly expected by a bank or anything like that.
All right, good. So you have some capital backing you up. Let me start from the very top here. I mentioned in the first segment that we've got an approach here that professional investors use to first identify a market that they think has upside. And so the first thing that I did, it's funny because in the first segment I was kind of beating on Zillow's economics department, but then I went to their website because they have some pretty cool tools here that if you go to Zillow.com and you go to the tab on the top that says local info, and then under local info, you can put any state, any zip code, any city in the country. But there's two things that are important. One, you want to change the index to show you 10 years. Zillow, as is their bent, always wants to focus on short-term analysis. And so they miss the big picture. But they have the ability, if you change the settings, to look at 10 years. I'm looking right now at a 10-year chart of the state of Hawaii. And what's interesting about it is that basically, that market went absolutely haywire from the beginning of, 10 years ago, from 2001 all the way until 2007. It went from a median sale price, and this is the entire state, of just above $200,000 to a median sale price of just above $450,000. So the market more than doubled over that period, but that's not so unusual, right? You have a lot of places around the country that saw meteoric appreciation during the boom and then gave it all back. Not the case in Hawaii. The chart then shows that Hawaii basically came down after the quote-unquote bust that everybody keeps talking about from $450,000 to $350,000, and that's where it stays right now. It's actually hovering a little bit above $400,000 as a median price right now. So what does that tell us, okay? Number one, it tells us that something about that state has defied the market correction. Okay, the prices doubled. They didn't triple, but they doubled during the first part of the boom, and then they stayed there. So the next question that I would have is what's happening in Hawaii? We know it's a beautiful place. We know that it's world-renowned. People want to go there, but what's happening that could be making it so recession-proof? Because, again, normally there are places that I could show you like Memphis, Tennessee or Houston, Texas that have incredibly stable real estate, but it's stable on both sides of the coin, right? They didn't see a boom, so they don't have a big major hangover either. Here they saw the boom, but there's no hangover. I don't know. Is that like it's like high-grade tequila, right? You have a party, but you don't have a hangover. So the next place...
It's jobs, my friend.
It's jobs.
Jobs out there.
What do you know about that you can tell us?
Well, I know that there's basically jobs in the military out there where they were building a base, so that definitely accounts for part of the boom out there. Myself, I'm going to be a teacher. I don't know how great it's going to be, so I don't want to take a big risk. I was thinking of just buying some vacant land and watching my investment grow and then build a house on it after I finish my PhD.
Well, here's the only downside of vacant land is that it won't generate any cash flow. If you buy it with cash and you can sit on it, all you can be paying is the taxes, and you don't have much to maintain because it's vacant dirt. And so in those kind of situations, vacant land can be okay, but you're not going to do anything but see appreciation. When you buy, and this is something you have to evaluate for yourself, and we can talk after the radio show to get into more detail on what your plans are. But, of course, if you've got an improved piece of property, meaning there's a building on it, a house on it, you can generate rental income. And if you're paying cash for that, that's all income to you. If you have a mortgage, you want to try to see if you can have positive cash flow from it. But That's the equation there. How much money you're working with. Let's say, for example, you're working with $100,000, just out of thin air, okay? $100,000, and you could buy vacant land with $100,000 and have no mortgage at all, or you could buy a house for $200,000 and have half of it be a mortgage. The question is going to be, how much rent can you get from those tenants, and will it give you a positive cash flow each month? If that's the case, the house is probably the better bet because, A, you have some leverage working for you. Every point of appreciation is based upon only having put half of the down payment down, not buying it in cash. So you see a greater return on investment that way. But I want to jump to something else. I want to give you guys another tip. And by the way, everything that I'm sharing with you, you can find at ownamerica.com. We have a research tools tab on the homepage. And there's a website at Forbes.com. Forbes has created a map of the U.S. You can click on any county in the U.S. and it will show you graphically the migration patterns. And what I'm looking at right now is the state of Hawaii has got a massive inbound migration coming in from California. So that immediately tells me that, A, I know Californians are pretty comfortable with Hawaii because it's off their coast and they do a lot of vacationing out there. But any place that's drawing population out of California, a lot of that is because companies are leaving California. People are leaving California because the taxes are too heavy, and they didn't do anything about that in the last election. A lot of states like New York made some major changes, New Jersey as well, where they elected governors who ran on the platform of getting the government spending under control. That didn't happen in California. And so California is going to probably be the last state in the union that gets their arms around this problem if they ever do. And that means that for the foreseeable future, whatever reasons there are, people are leaving the gorgeous state of California to go to the gorgeous state of Hawaii. That's very likely to continue.
Wow.
I don't have much more time for this part of the call, but I really appreciate it, James. I hope this was helpful to you. I think you picked yourself a winner. Making sure that you do it in a way that you can afford and do it smart is the most important thing. If you want to email me, send me a note at greg@ownamerica.com. We can talk in more detail about your personal situation. Thank you very much for the call.